All right, so the meeting is recorded, and I'll go and get started. Okay, so first of all, thank you very much for joining us on a very short notice. I know I've been wanting to do this, but in the last few weeks, I didn't think it was a good time because everyone was distracted by the Thanksgiving holiday, and then of course after Thanksgiving, everyone's recovering from Thanksgiving, right, from traveling or their families and stuff like that. So I thought this Monday would be a perfect time to be able to get together to talk about this real estate fund that we're looking to grow and develop for a lot of opportunities coming up. So a little bit of history. We've done a lot of syndications in the past, so many years. I've been involved in real estate since 2011, and we've raised money for so many deals in the past, 14, 15 years. And a lot of people who have actually been part of the fund have made an incredible amount of income just by investing as a passive investor. And most of them were just single family houses and condo conversions, things like that in the local area. But as we venture off and grow, we've sourced and getting tons and tons of opportunities outside our local area as well, which is what I'm most excited about. And let me tell you why I'm excited about it. All right. So I live in Virginia, Northern Virginia, near DC. We've done a lot of deals in DC. All right. DC is a great market when it comes to job and the federal government providing employment as a stable job market. However, the bad thing about DC is that it takes forever to get anything done when it comes to paperwork, specifically DCRA, getting permits, zoning, variances, and things like that. They take forever. For some reason, they move at a snail's pace, but yet they charge. Like we're buying a Cadillac, but we're not getting Cadillac service, right? Um, but in other locations where they're more pro-growth and there's not a lot of competition, and actually the local municipalities and local governments are very, very incentivized to grow the area, they don't have a lot as much red tape as they do in places like DC or large cities, right? And they're moving paperwork so much faster than what I'm used to seeing in the local area here in DC where I live. So yeah, that's why I'm creating this fund because I've seen so many opportunities come across my desk and in my email, but I can't take advantage of all of them because we have opportunities, but not enough capital to be able to do them all. Okay, so I'll go through exactly what we're going through here. And again, same thing. If you guys feel free to drop any questions in the chat, and we'll get from there. Okay. So a little disclaimer: everything here is proprietary and confidential. Please don't send it off to others without our consent and permission because there are some liability issues that we want to prevent and any foul play there. So please work through us in case if there's anyone interested in what's being said here or want to listen to the recording, just let us know, and then we'll trust you guys to pass it along. And if there's any questions, then we can address those later on from those future people who may look at this. Okay. A little bit of executive summary about us. Fortune Homes Capital. We're excited about offering a real estate equity investment, the fund, and we're looking to raise about $25 million in aggregate capital for residential, mixed-use assets, and commercials throughout the United States. So not just the local area, but throughout the entire country where the market's good. And there's a very friendly environment for growth when it comes to the politicians, right? Our strategy is to work with developers and ourselves, we're developers as well, to acquire real estate assets in high demand markets throughout the country. And then once the acquisition is complete, then we'll just put it together, roll up our sleeves and do our value add strategies. It could be developing the lots. It could be selling it to an end buyer. It could be building vertical. It could be a number of things, right? It could be rezoning and adding value from that impact right there. So there could be a number of things. So our target raise amount you see here in the yellow box, 25 million, minimum raise $250,000. But the higher the better because obviously the when you have a higher subscription amount, then we'll have less people involved and becomes less management on our side, which offers us the ability to give more returns for those involved, right? So if we have a lot of people at low amounts, then we have to spend more money on management and taxes and accounting and stuff like that. But we have less people involved, and guess what? Then all those expenses go down and there's more returns for those who are already involved. Okay. So again, property types, mixed use, commercial, residential, preferred returns are anywhere between 6 to 8%. And the target equity growth, in addition to the preferred return, is 12 to 14%. Okay. And all this is secured by some kind of legal instrument behind that real estate. Okay. So this is not like you put in your money into a savings account and then you get 0.5%. All right, but you can withdraw at any time. In this case here, you're committing the money for a certain period of time for the investment to be complete. Then you get the money out with the returns on investment. So this is attractive to a lot of people, and a couple of reasons is because As an example, if you're getting close to the retirement age, or maybe you're thinking about retirement and you want to invest your retirement money and then get those gains back, pre-tax dollars, and put it back into another investment, you can do that through a self-directed IRA. If you have a life insurance policy, cash value, you can get the cash value to invest in that and then pay it off and then reinvest that. So there's a lot of different tax strategies that allow you to get a bigger bang for your buck, okay? So as an example, if you invest $50,000 into the stock market and your gain is $25,000, so you got $75,000 back, you got $25,000 capital gains. And that gain has been realized that year because you sold that stock or mutual fund. And now you have to pay taxes on those $25,000. Well, wouldn't it be nice if you had some kind of mechanism to take the $25,000 gain, reinvest it, never touch that money, but reinvest that full $25,000 back into some other investment before you ever pay taxes on it, right? Because once you pay taxes on $25,000, depending on your income bracket, you're going to be less. You're going to have less than $25,000, right? So in this case here, with a different strategy, you can reinvest everything pre-tax, and the snowball effect happens much faster than if you pay taxes and then reinvest and then pay taxes again and then reinvest. Okay, in this case, you're just getting gains and reinvesting all the gains pre-tax, so the snowball effect happens faster for you, and you build your wealth even faster for you and your family. All right. So this is just another chart showing the different management companies that we'll have going on. We have FH Fund 1, 2, and 3. And then our management company, Four Tremors Capital, is an overarching management company that manages all these different deals and funds and with different strategies, okay? So $25 million to raise, $250,000 minimum subscription, all right? So what is our strategy that's unique compared to other deals that you may have looked in the past, all right? Well, we underwrite them in a very strict manner, okay? Well, because we have so many opportunities come across our desk and our email, we don't have to do all the deals. We're not, trying to get every deal that we see across there, even though they're marginal, all right? So what happens is that a lot of people in Wall Street who are managing a big fund, such as hedge funds or pension funds, all they're looking for is maybe a 5, maybe 6% return, and they're happy with that. And so what ends up doing is that these fund managers are paying at very high premium prices for these assets that are giving off very low returns, and they're okay with that because their goal is just to earn 5 or 6%. In our case, 5 or 6% is not worth our time, and it's not worth your time. We want to get something much higher than 5 to 6%. We want in double-digit territory, but we want to do it in a way where it's safe and secure for the principal investors. Okay, so when we look at the deal, we're going to underwrite based on our guidelines. We're going to take a look to achieve targeted returns that makes it attractive for everybody. That's much more than a 5 or 6% return. The developer and the sponsor must show a strong history of successful past performance. So in other words, we don't want someone brand new trying to figure it out and then have your money in the mix of everything while they're figuring it out. Okay? No, they have to be some kind of sponsor or principal involved that has some experience and has consultation with those people to make sure that the risk is relatively low, because there's a knowledge base for successful deal performance. All right. And then, of course, with regards to the risk analysis and the pro forma, we want to make sure that, hey, Murphy's Law, if everything can go wrong, they probably will go wrong. And or when they do go wrong, you want to make sure you cover all your bases by having contingency in there. Contingency for both soft and hard costs when it comes to the actual project. So, of course, the bigger the project, the bigger the dollar amount, but the percentage is still the same nonetheless. Okay, and then control. We love control. Now, I mean, I'm not a control freak when it comes to people, but when it comes to managing assets, I like control, because what you can control can't harm you, and what you can control can move in the direction that you want it to go towards. All right. So, in what we can control in real estate is the purchase price. We can also control what we're going to do with that asset. How will we add value, and how much value will be added based on how much money is invested into the deal. All right. And also, what is a strategy? What is our exit going to be? Is it going to be selling off to an end buyer? Is it going to be to refinance because it's going to be a rental income, a stabilized rental income? What's the exit strategy going to be based on the buying criteria? So it must be crystal clear on the end game before we even consider looking at it deep in detail. If someone's really wishy-washy, that means that you don't have a clear vision of what the asset can be. So we prefer to step away from that, let them figure it out first before we take a deep dive and invest any more time into that. All right. Also, all right, we want to make sure that if there's going to be a buy and sell type scenario, you want to make sure that the end buyer, there's a very clear sourcing of that end buyer. Who's going to buy that deal after you add value to it? Is it going to be a retail buyer? Is it going to be a national builder? Is it going to be, what kind of people who are going to buy your product after you're done with it? Okay. And we prefer, if it's going to be as an example, as land development, if we're going to have a land development deal, we prefer that deal already be sold to a builder who's going to build it vertically. All right, we can do the land development and build the horizontal, meaning that you build the road, you build the stormwater management, the taps for the water, power, and sewer. But then you sell those lots after it's entitled to the national builder, and they make money by building the actual houses because they have the capacity to do those things. All right, they have the economies of scale to make a profit of building large homes. Okay, and also a market analysis, making sure that there's a demand for what's being produced there. Okay, so if there's no demand there or not convincing demand, then why are we trying to, why are we trying to force demand or force a product when there is no market for it? Okay, so it has to be aligned with the targeted rents, resale value, and so forth. So our targeted opportunities are, three basic assets. Okay, residential fix and flip, residential and commercial land development, and multifamily development. Okay, so those are our target opportunities, pretty clear and cut, and each one has a very specific way to do them to make sure that it succeeds. So let's start with a quick case study. Okay, these are real examples now. All right, this is an example of a fix and flip. This deal was actually done by us personally. It was then done in Southeast DC. The investor who invested in this deal invested $280,000, and with the $280,000, got a preferred return of 7%. Now the duration of the whole time was only 6 months, being in and out when it comes to this deal. Okay, you see here the before and end pictures of what we had to do. In fact, you look at the picture, I just noticed that this house was vacant for 3 years, but for some reason they have clothes hangers in the kitchen, and there's towels, there's looks like an underwear there. It's kind of odd, right? But this is the problems that we encounter in the marketplace, and us being problem solvers, that's where the opportunity is. Okay, so the bigger the problem, the bigger the opportunity. So we can't be scared of big problems, right? So this person, because of the equity growth in the sale price, they got another $29,000 in return for a total of 29% return APR on their money across 6 months. Okay, so they're really happy with that. And this type of investment, by the way, this is just not a one and done type deal. We have a large network of people who do fix and flip. In fact, we used to run an education company, and we've trained over 1,000 students on how to fix and flip. So we have a large marketplace of people who strictly fix and flip, and they're always looking for financing and capital to be able to do some of these deals. All right. So this is a very high volume type example where it could be over 50 deals a year annually like this, and we can have a fund of $15 to $20 million just for this alone. That money will be deployed day and night for this particular strategy. Okay. Here's another case study. This one is with regards to land development. Okay, now this particular project is in progress right now. This is located in Fayetteville, North Carolina, near Fort Bragg. And the developer here, we got a picture of myself and those involved in this particular deal here. They took 45 acres of raw land and entitled it with the city of Fayetteville to allow for 170 single-family home lots. And all they got to do is clear out the trees and flatten the road and build the stormwater management and the horizontal infrastructure and so forth, and have the utilities in each lot. And it's already pre-sold to a national home builder. They've already released a earnest money deposit because they're very hungry to buy this deal. And so that was a very low risk proposition. And the investors involved in this deal are in the best risk position. They are in first senior lender position. The only people who can get paid before them is the government when it comes to taxes. All right. No one else gets paid until they get paid first, their principal and what they're owed with their preferred returns. So that's a great position to be in because it's a no-lose situation when it comes to a capital stack position. Okay, the investment amount for this one is $2 million, preferred return 8%, projected equity growth of 25%, for a total of 33% total with a duration of 18 months. Okay, so we have already raised the first phase of this project, and the acquisition was done back in March. but we're looking to raise another million or so for parts of the construction phase for this particular deal. Okay, so the land value has already doubled in value because it is entitled and construction's already started. So again, it's still a very nice risk position to be in to be part of this actual deal here. Okay, here's another one just down the road, about 10 or 15 minutes away from the other one I just shared. This one is 10 acres, all right, but because the land is, the topography is very hilly and slopey, and there's a lot of slope, we're actually going to the city of Fayetteville only allowed about 5 to 6 acres to be entitled for development. Okay, so of the 10 acres, about half of the actual area will be built with 45 townhomes. So this is the site plan on the left side. Here's another picture of us and those involved in that particular deal. The investment in this amount was $1 million and preferred return of being 8%. And because this one also involves building the vertical on that side, the returns on equity is actually much higher because of that extra growth in that area when it comes to building the actual townhouses. Okay, so the duration of this is 24 months. Projected return is 35% on their money. And that's been going really well. Again, it's already fully entitled. That's the site plan on the left side, and they've already moved the dirt, and now they're ready to build the first set of 12 townhomes to be sold in the open market. Hopefully by this spring here, when the spring market hits, and maybe by that time, interest rates would have gone down too, which would have been great when it comes to a profit sharing standpoint, because now it would sell higher than what we had projected in our pro forma. In our pro forma, we had conservatively put a sale of each townhouse at $295,000. But again, if interest rates go down, all right, and the market remains really strong as it is right now, there's a potential that people can afford more house than what's on the fan, that's than what they have thought originally. Okay, so so it may be sold for, instead of $295, excuse me, it may be sold for $300 or $310, especially when it comes to some of these end units. And the way to design this, you'll notice the lots here. There's 4 townhouses here, there's 2 here, there's 5 here. They purposely separated these so that way there's more end units. All right, and as you guys know, end units are more valuable than interior units. So the more end units there are, the more likely it is to sell at a higher price. And the blended sale over the 45 townhomes may be much more than $295,000. Okay, so that's that particular example there. Excuse me. All right. Excuse me. So there's another opportunity also in Fayetteville. And yes, guys, we love Fayetteville because there's a huge demand for housing there, and the local government is so friendly to growth, and they're doing entitlements so fast. Okay, but this over here in their little red trapezoid here is 9 total acres. And I'm sorry, there's a typo. It says law of land. It should be 9 acres of land with a rambler. And this one we actually developed with 36 single family homes in this little red box here. Okay, so it's already pre-sold to another national builder with a ratified contract, and they've already deposited $600,000 in escrow, which means they're going to perform. I mean, these builders, they're going to put money down. They're going to put the money where their mouth is. They're not going to lose out on $600,000 and not perform. So they're serious about that. It's non-refundable. Okay, and that's the first deposit. The second deposit is another $1 million. So it's a total of $1.6 million deposit on this deal here. And the investment for this one, pretty straightforward. It's a very low raise, $450,000. And with all the numbers, 8% preferred, equity growth, total of 32%. And this one is unique because the duration is only 6 months. And the reason why is because on the lower left side, that's another phase that's being built right now. All right. On the red box, that has not been purchased yet, but they did all the entitlements all at once at the same time for the same cost. And so they got all the paperwork done. It's already shovel ready. All they got to do is buy the land and then go ahead and proceed. And they only need 6 months to get it done because all the entitlements had already been done way ahead of time before they even purchased the property. Okay, so this is a nice position to be in because the purchase price of this land is $800,000, and in our position, when we raise to $450, we're at a 55 to 57% of LTV of the entire deal. So that puts us in a great position in first senior lender position. Okay. All right, let me pause here real quick, guys. Are there any questions so far about some of these opportunities and case studies, by the way? Any questions? No questions? We're good?
Oh, yeah.
Okay, good stuff. All right, moving on to the next one. This one is a multi-family one, okay? Also located. Now, this one is actually in the best location because it's only half a mile away from Fort Bragg. And for those who have friends in the Army, in the U.S. Army, or maybe familiar with Fort Bragg's barracks are in horrible condition, and most of the soldiers who are either officers or enlisted, they don't stay in the barracks because they're in such terrible shape. Now, the Department of Defense has tried to renovate them to remediate the asbestos, the mold, but for whatever reason, these old buildings, they keep coming back to unhealthy conditions. So that's why the military has provided stipends for a lot of the folks to be able to live off base in a more safer environment. So there's a huge need. I mean, there's 200,000 soldiers who are stationed there, and there's a lot of people come and go all the time. And there's a huge recruitment of U.S. military recruitment since President Trump's been in office. Everyone wants to join the military now, so recruitment numbers are skyrocketing, and they need more housing for these soldiers. Okay, so in this particular case here, you see here, there's a building over here, and there's a building over here. All right, so these are buildings that maybe I think 10 or 12 units or so back there, but they're all outdated and in very bad condition. So in this case here, we're going to purchase that old building, we're going to knock it down, and we're going to build 150 new apartment buildings with a swimming pool and amenities, and also expanded parking, so that way there's parking space for every person who lives in the area, in the apartment complex. It's a high demand rental market, so the whole strategy is to rent it out, refinance the equity out with a traditional lender at low interest, pay back all of our investors, and then some, and then have stabilized rents afterwards. Okay, so the investment amount for this one is $4 million. All right, preferred returns 8%. With an equity growth of 14% for a total of 22, and it's 36 months hold here. So the good thing about this, though, all right, is that once they build the new construction and then they start renting it out, rental income will start coming in. And at that point, they can start making interest payments, so that way there's cash flow coming in, and you're not waiting for the entire thing to be done before you get some of your money back, okay? So that's the nice thing about multifamily, is that when it's stabilized, you can get cash flow because there's rental income that allows us to be able to do that. But once there is rental income, at the projected rental income that we're looking at, then the value of the property and its operations will skyrocket like crazy, which allows us to refinance out to a traditional lender based on that new balance sheet and income statement. All right. All right, and here's another one. This one's in Georgetown. All right, so this one is located right in the neighborhood of Georgetown, a very expensive area. This particular one, the developer is very experienced in doing this kind of project, and the raise is $8 million. But they're taking this old building here, looks like a warehouse, and they're going to turn it into 65 to 69 luxury condo units to sell out. And then with that, they also have parking spaces for sale as well in the basement of this building. So obviously with 60 some condo units, that's more than enough spaces for parking for the people who are going to buy there. But then there may be a surplus of parking space they can sell to the open market as well to get even more income. All right. So this one, a little bit more conservative, all right, a little less return, but a lot of people like this better because there's no uncertainty on it failing, because this is DC, this is Georgetown. I mean, what is the likelihood of Georgetown, deal in Georgetown failing, right? So the likelihood is very low. The returns are less because it's a higher dollar project, and there's a lot of luxurious things that's being put into these particular deals, all right? All right, this one doesn't have a picture yet. This one is one of the ones I'm most excited about, all right? For those who live here, you guys know we're very predominantly federal government presence heavy in Northern Virginia and DC, right? Military alike, all right? The U.S., if you look at the Pentagon and where it's situated, right across the street is Arlington, Roslyn, actually, and then right across there is Crystal City, all right? And of course, across the river, you have Washington, D.C., all right? So just imagine, if you look at Crystal City, who are the types of people who either own or rent out in buildings there? Usually it's Raytheon or Lockheed or Boeing. Most of them are all defense contractors for the Department of Defense at the Pentagon, and they meet with their customer at the Pentagon on a regular basis, okay? In this case here, Fayetteville has Fort Bragg. The Fort Bragg is a U.S. Army training camp, all right? But part of the strategy for the U.S. Army is to start utilizing drones more, not the big drones like the Predators that launch a missile that's from a far distance, but these are personal drones for soldiers, All right, so there's a whole new strategy for fighting war out there, and they want to be able to work with a contractor nearby Fort Bragg so they can look at the specs on how things are being built that they're buying, that the U.S. military is buying from these people, and then come back and be able to test them and train with the soldiers right there across the street. All right, so we're looking to develop 150 acres either into a data center or factories for the DoD contractors who's going to build drones for the U.S. Army right down the street. All right, so this is a very high opportunity here. The raise for this one's $8 million. Preferred return 8%, equity growth projected to be 26%, and the duration, I believe, is actually going to be a lot less than 24 months. All right, because the folks that we're talking to right now that are defense contractors, they're not really looking for us to do any kind of vertical construction. They're just looking for us to rezone everything to industrial or high dense commercial use, and then build an access road, and then they build everything on the vertical level. We just take care of the horizontal and the infrastructure. All right, and then we sell it to them, and then we move on to the next deal. So again, a very great opportunity for this particular deal here. All right, here's another one on page 13. There's another one that's picture. We don't really have a picture yet. We only have an appraisal, but developing 525 acres into a residential commercial mixed use, including Costco, Cheesecake Factory, and movie theater, and more. This one, the reason why this is here, and we have it under contract, but it's going through a feasibility study. We're not going to even address purchasing it until probably the latter part of 2026 or maybe early 2027. All right, because there's a lot of other deals we got to focus on first. All right, and making sure that this one's kosher. The reason why this is on the table is because the mayor of Fayetteville and the city council has expressed strong interest to make that city to be the third largest city in the state of North Carolina. Right now, they're number 6. So to make it number 3, they got to bring certain services down from other cities, such as Raleigh, Durham, and Chapel Hill. All those areas have services that Fayetteville does not have. And people who live in Fayetteville have to drive 45 to 50 minutes to get these services in a whole nother city. So they want to be able to have a developer like us and our team to be able to create these services, commercial, residential, and such, to create these jobs and opportunities for people and build it there. So that way people who live in Fayetteville stay in Fayetteville and spend money in Fayetteville. Right, so the money goes around the circle in the same community. Instead of making another city rich, they can focus on getting their own city rich by keeping the money in that city and having people spend there. And of course, you get tax revenue for the city and so forth. Okay, so this one's a 36-month duration, 35% return, a huge opportunity. Total raise of a $35 million. I'm sorry, $30 million. Excuse me, on that particular raise right there. All right. All right, so let me stop there. These are the current opportunities that we have and the ones we've done. I did a couple of case studies, but are there any questions so far about what's been said here, or any feedback or thoughts about what's been presented here?
None but.
Thank you, Vince. Anyone else?
So what's the risk for an investor? Anything that you can talk about the risks?
Good question. Is it Raj?
Yes, yeah.
Okay, hey Raj. So the risk here, all right, when we underwrite it, we want to make sure that the money risk is out of the equation by underwriting it properly and putting it in the best risk position possible. All right, so the principal will still be there, although it may not be liquid. The only risk I can say that occasionally that may happen is there may be a delay in the project. Such as maybe the entitlements are taking longer than expected, or maybe when they started construction, they're finding out that the land has certain things that wasn't accounted for in the initial feasibility study, right? So the risk there is the duration of the actual thing, and the risk is maybe a lower return because there's extra costs associated with it. But again, we mitigate that risk because of contingency. So if those risks are not realized, whether it be a delay or whether it be a construction problem or whatever, then the contingency goes back to the bucket as profit, and the return on investment gets even higher when it comes to the equity growth. Okay, and then the other risk too is an example of land development, right? So let's say we have a builder who put a contract on it to buy the property or buy the project after it's done, and then they put a deposit down. Well, there is a risk for whatever reason that they belly up and go bankrupt. Okay, so how do we mitigate that risk? Well, 2 things. Number 1, if they belly up and go out of business for whatever reason, that deposit stays with us. Their deposit they put down already stays with us, so we keep that to as a default because they defaulted on non-performance. All right. And the second way to mitigate that is that we have other builders in line who already submitted a letter of intent interested in buying the deal if the primary person backs out. So that way we can move that forward. Okay. So we mitigate those in two different ways. Does that answer your
Okay.
question?
Yeah. Yeah.
Good question. Very
But I
good.
mean, is there I know because these are various levels of return on these projects. So not sure what project has a kind of risk level. So that's what I was thinking, like, various durations and various returns.
Good question. Well, I can tell you right now, the ones I'm most excited about are these ones right here. All right. That's what actually this is not multifamily. It's not another type. I'm sorry. This is land development. This one here, because it's already pre-sold. All right. It's a very low risk proposition. All right. 32% is a pretty good return for a very low risk investment. All right. In addition to that, is this other one that I shared earlier that we're raising another $1 million for to go to tackle the next phase of construction before the first set of townhouse our first set of lots are being sold to the builder. All right. So I like this one the most here. And then I like this where'd it go? I like this one the most, all right, because it's already pre-sold with the deposit. I mean, it's if you take a look at the details, and I can always provide more details privately for those who are interested, is that it's no brainer once you take a look at all the information.
Okay.
Okay.
I don't know if you said, Jan, what the actual commitment was. What are you looking at from a commitment standpoint?
From a financial standpoint, so we're looking for a minimum of $250,000 subscription for any one of these deals. Now, some deals like this one here that's a little bit smaller, we can take a smaller subscription, right? Maybe 100,000 or so forth. But most of them are $1 million plus. We're looking for 250,000 or more. And then the higher the subscription, then the higher the preferred return. So, preferred return, if someone came in at 450,000, they're going to get 8% straight up. But if they're coming in with maybe 100,000, they make it something like 6%. Okay, and then something with a different tier, right? So, yeah, the subscription amounts will dictate the max, how much we're going to get in return from a preferred standpoint, plus the profit sharing standpoint. Okay, but the reason why is because we're not treating anyone different is because there's extra administrative and accounting costs when you have more people involved, and we have to offset that with those expenses.
Gotcha. Thanks.
Yeah. Does that make sense? Okay. Good stuff. Anyone else have any questions?
So the preferred return starts immediately once the funding is made?
So once the funding is made, and then once acquisition is done, right? Usually what we do is, let's say closing is, let's say this Friday, right? We generally will do all the paperwork, between now until Thursday. And then assuming everything's good, then we expect a wire on that Thursday. And then we deploy that money for a closing on Friday. And that's when all the preferred return starts, is that Friday.
Okay.
Okay. And that will continue to accrue until the principal has been repaid in full. Okay.
So the preferred return will not be given until the end of the closing of the development. Is that right? Or
for this particular one that I shared earlier that I was about, then yes. But in this case here, it's only 6 months.
okay.
Yeah. Okay. Okay. Good questions, guys. I like these questions. Any other questions? No other questions? Okay, guys. Well, if you guys like here, what I'm going to do is I'm gonna copy this link and type into the chat. So if you guys can, let me get that done here. And if you guys can, just go ahead and go to the link and go ahead and submit a form. This is just this is not giving any kind of commitment whatsoever. But if you guys are interested in any of these deals here, what you can do is fill out the form or email me directly. All right. There's a QR code here, by the way. But my information is here. You fill out the form and then set up your goals here and set up how much you're willing to commit or you're able to commit. And then we'll talk more in detail when it comes to soft commitment. Okay, so once you fill out this form, you're not committing to anything, but it's just a way for me to track. Say, okay, well, so and so John Doe is interested in investing $250,000. Here's what his goals are. Okay, then what I'll do is our team is going to reach out to you guys individually and say, okay, well, hey, John, we're gonna look at your investment here. Your goals are this, this, and that. We have these particular opportunities available for you. Would you like to move forward if your money is available by this date? Okay. And then from there, we're going to deep dive into that information for that particular investment to make sure that John is comfortable with that investment, understands fully the disclosures of what the risks are involved, and also what the rewards are involved, and how we will manage that fund, and how we'll communicate status and progress of that investment he chose moving forward. Okay, so if you guys can, please go ahead and click on that link. All right, fill out the form. Make sure you have my contact information. I'm going ahead and type into the chat as well. All right, since it's hard to grab that from the screen there. All right, so I just typed that into the chat. All right. Oh, I have a question here from BJ Thomas. Says, since you are showing both preferred and equity return as APR. Good question. If the project runs 2 years, APR continues. It's annualized. All right. So if it's 33% over 2 years, then 33% times 2. That is correct. Okay. So that's a very good question. Thank you for that, BJ. Okay. Good stuff. All right. So yes, please go ahead and fill out the form. Like I said, here's a QR code in case you guys need it. And there is that one deal that that's the $450,000 raise that I was mentioning earlier. We are looking to close that one before Christmas. So if you guys are interested in that one, just give me some kind of a verbal commitment. Again, nothing signed yet. Just give me say, hey, Jan, I'm interested in being part of that one. Then we'll talk more in detail on Friday or sometime over the weekend and let you guys know what the next steps are and what to expect. And then we're looking for that funding probably sometime on the 21st or 22nd or something like that before Christmas. Okay. So so I have a little gift wrap here on the Scam Me QR code because we're in the Christmas holiday season. This is a gift wrap for you guys with a good investment for you guys to grow your wealth with you and your family. And so I've been involved in a lot of different syndications, guys. A lot of them give maybe 15, 18, maybe 22% at most. And a lot of them sometimes don't go good. I mean, in fact, 3 years ago, I got involved in a multifamily deal and I still have not had a preferred return yet. They're supposed to give me payments every quarter, but for some reason, something went wrong during COVID and rents were not coming in as they were expecting. But I've seen a lot of people how they manage it, and there's a good way to manage it, and there's a not so good way to manage it. Okay, so I pride myself on how we manage the fund by underwriting the right deal, so that way we don't run into those problems. But of course, I can't promise anything. You know, stuff does happen, but we do our best to mitigate that by making sure we do our homework and making sure that people get what they're due and promised at the end of the day. So with anything, there's always a risk, but there's also a high chance of reward as well. Okay. All right, guys. Well, thank you so much for your time, and I look forward to hearing from you guys. If you guys can fill out the form, that'd be great. Just click on that link, and feel free to pop me an email or send me a text if you guys have any more questions, all right?
Roger that. Thanks.
All right.
Thank you.
Thank you. Take care now.
Yep. Bye-bye.
Bye-bye.
Yeah.